Approximately 2 million short-term rental properties could flood the market in the next 12 to 24 months. And in this video, it's going to be about what real estate pros and investors need to know. I am John Howard, and in this short video, I'm going to talk about that subject. We are witnessing, what could be a transformation in the short-term rental market that could potentially shape or reshape the real estate landscape for the next decade. There are multiple critical factors occurring simultaneously. National occupancy rates in terms of short-term rentals, right, according to AirDNA, national occupancy rates have plummeted from 61.7% in 2022 to just 48.3% today, with markets like Phoenix, Miami, and Nashville seeing rates drop below 40%. Meanwhile, operational costs have gone up. To give you an example, property insurance alone has increased 34.2% nationally, with some investors facing 150% plus premium hikes. I actually saw this somewhat myself. I mean, it was, certainly with 2022, one of the properties I do is a kind of a hybrid short and medium term rental. And the shorter terms were very strong in 2022. Doggone it, even in 23. Well, I started seeing vacancy I wasn't used to seeing in 2023. But, for the most part, because I do mostly medium-term rentals, I held on pretty strong. So things were pretty good. Okay, so over 2 million Airbnb and VRBO properties are positioned to flood the housing market as financing structures unravel. Approximately $318 billion in short-term rental loans require refinancing by the end of 2025, and that's really in the next few months, right? With rates jumping from pandemic-era lows of 2.65 to today's 6.7, consider a real example from Scottsdale. A property purchased for $650,000 in 2021, with an exceptional 25% cash-on-cash return, is now generates 90% less cash flow just because of that particular property. It's experiencing less cash flow on Airbnb and VRBO. If it's refinanced at the current rates of 6.7, it would operate at a negative $820 monthly loss. The most exposed markets tell a striking story. Pigeon Forge, Gatlinburg, Tennessee, has 43.7% of housing stock are short-term rentals. Myrtle Beach, 38.2% of the housing stock are short-term rentals. And Panama City Beach, 36.2%. These markets face potential price corrections of, let's say, 30% or more. Any way you cut it, it's pretty extreme. There is a three-phase timeline, in terms of how this transformation may unfold. Number one, there's going to be early exits. Current, right now, basically summer 2025 until the end of 2025. Potentially 400,000 to 600,000 properties from highly leveraged investors. The second one is mass exodus, fall of 2025, which is right around the corner, through spring of 2026. 800,000 homes up to 1.2 million properties as reserves deplete. Number three, capitulation, 2026 until 2027. 300,000 homes to 500,000 properties as structural shift continues. So this might not be just about, market turbulence. It could be a complete, let's say, recalibration. For real estate professionals, this could be both a challenge and an opportunity. Warren Buffett's wisdom, timeless wisdom, applies. Be fearful when others are greedy, and be greedy when others are fearful. The most successful investors during the 2008 cycle shared three traits. They focused on cash flow over appreciation. They leveraged relationships before distressed sales hit the market. And they understood structural versus cyclical changes. Whether you're advising clients, managing portfolios, or planning just your personal investments, data-driven decisions will separate winners from casualties. The coming 12 to 24 months will create wealth-building opportunities potentially not seen since 2008, but only for those positioned correctly. The question isn't whether the shift will happen. I mean, it's already happening, right? The question is whether you're going to navigate it, and if you decide to navigate it, will you navigate it successfully? So how about you? What are you seeing in your markets? So what's interesting for me is I actually already owned rentals back during the Great Recession, back in 2008, which really kind of started in 2007, which crazy is, at the time I had built up a pretty successful internet lead generation business. I had 15 employees and 2 offices and was doing pretty substantial revenue, and I had 2 rentals. So I lived in my one property in by the beach in Los Angeles, and then I had another house. It's at a private lake, and I still have it, and that's what my medium-term rental is now. But basically, that rental back then was doing pretty well. And then, during that whole time frame of, let's say, 2008 up to 2012, I did move out of my primary residence where I was living and I owned, by the beach in Los Angeles. And then became a renter, right, of my residence. And so I was, renting 2 places out. At that time, though, property values really dropped. And I think they dropped, at or near or maybe even below what their mortgages were. Fast forward to now, here we are. This is this is almost 20 years later. What is that? Basically 18 years later or 17 years later, from 2008 to 2025. And it's like, I've paid a lot of the mortgage balances down. I mean, they're not totally paid off, but I've paid certainly, the mortgage balances down. I'm certainly guilty of borrowing some money from the properties as well. But the point is the property values have gone up a lot, and the actual mortgages that I have are 30-year fixed 2.875% mortgages. So I'm certainly not going to be selling, or, I certainly hope not, right? The only way would be if I was forced to sell. But in any case, the point is this same thing happened to me, and my mentality was more like I just kind of want to hang on to what I have. Now, I did look at some other places in Los Angeles back then. I certainly wish I had done it. It would have been great, but just didn't really have the means. I was certainly feeling rather traumatized about having a business kind of evaporate. We were actually in the mortgage lead business, so selling refinance leads and then shifting the company around at the time. We did do a good shift where I shifted and actually did a merger with our biggest vendor and became an email marketing agency. But anyway, over the last 2 decades, I've actually done short and medium-term furnished rental alongside of launching and operating 4 different businesses that all got up to 7 figures or more per year. And, during that time frame, I, owned and or managed 5 different furnished rentals, right, that were going on Airbnb, VRBO, doing midterm rentals as well. Pretty much short-term, midterm, and even some long-term rentals in there as well. So it's something that you can do alongside of a very demanding career. In fact, high-income earners are really positioned best to do this because they're going to be the ones that are most likely to get the best mortgages, right, because of their high income. In fact, a lot of successful real estate investors are really just that. They're high-income earners that build their investment property portfolio with their good income. I've been doing a lot of content, on real estate lately because I believe that it's certainly really good to do alongside of other things. And I mean, if you think about it, as you kind of, go through life, and in my case, I mean, it's like, things kind of got a little crazy. I certainly had a lot of success in an entrepreneurial career, but then things kind of, went flat, right? But thank God I held on to my properties because, with real estate investments, you get basically 5 benefits, right? You get, appreciation, you get in rental income and cash flow, which is usually very high for short and medium term rentals. When you compare it against, let's say, long term rentals, you also get tax benefits. You get amortization, so you're paying, you get the beauty of paying the loan down over time, and then you get the ability to borrow against the property if you choose to. Now, there's a 6th benefit I don't always talk about, but especially if you're just someone that wants to own a few properties, you get the ability to retire, into one of the properties if you so choose. Like, let's say it's paid off and you're in your, like late 50s or 60s or late 60s, and you want to retire, you can again, retire in your paid off property or move into one of them or something like that. And that's, certainly an extreme benefit. So anyway, I'm not sure if this, information or this video excites you, but it certainly does seem to be a pretty unique opportunity to look at some properties to acquire in the next 12 to 24 months. And, again, 2 million properties going to be flooding the market. Potentially, could be a lot of properties, and a great opportunity to get some really good prices. If you all liked that video, you can consider giving the video a like. You could also consider subscribing to the channel. If you have an interest in getting to real estate, whether you are already or you're not investing in real estate, you'll see some links in the description area. I've got something called the SMTR Launch Kit, which stands for Short and Medium Term Rentals Launch Kit. You'll see some links. You can go there, check it out. It's very basic, very inexpensive, something you can review. I also have very basic, very inexpensive email coaching. Again, in the event you want to work with somebody or get some expert insights from somebody that is a little bit more of an expert than you. Other than that, you can put any questions that you have or comments in the comments area below. And thank you. Have a great one.